Friday Fluff recap. What were some big things that happened in the market this week? Let's do a top line review. Friday Fluff recap. What happened in the market this week? Quick top line review. Bond yields continue their early 2022 March higher today, with the 10-year U.S. Treasury yield settling roughly at 1.73%. That same yield was below the 1.4% just 3 weeks ago. So it's not a big move in absolute terms, but means that the benchmark yield has moved some 25% higher since just before the lovely Christmas holidays. So the S&P 500 slipped 0.1%, and the Dow Jones Industrial Average lost 0.5%, and the NASDAQ Composite stabilized after several days of declines, finishing down 0.1%. So the recent spike in bond yields has been rough. It's been rough for long duration growth stocks while boasting value stocks. So we'll have to keep an eye on that. The Vanguard S&P 500, the value exchange traded fund, is up nearly 1% since the start of the week versus the 3.5% decline for the Vanguard S&P 500 growth ETF. The index as a whole is down 1.4% since Monday. So the banks and energy stocks have done particularly well so far this year. The Invesco, KBW Bank ETF, and the energy sector, SPDR ETF are each up about 9%. And the ARK Innovation ETF, meanwhile, has slid 9%. That ETF is packed with high multiple growth stocks, like Tesla, Coinbase, Zoom, video communications. So we'll have to keep an eye on that. And the bond yields have been on the rise lately as concerns about the Omicron variant's negative impact on the economy have dissipated dramatically. Everyone put this fear-mongering. I listened to some conference calls in Africa with doctors over there and what they were seeing. It seems to be happening over here. So that means the Federal Reserve won't be likely to scale back its policy tightening plans for this year. In fact, the minutes from the Federal Open Market Committee's December meeting, which came out on Wednesday, suggested the risk could be in the other direction. So policymakers were more hawkish than many investors seemed, to be expecting. So that's interesting. And the higher interest rates will put pressure on pricey stocks and companies with more near-term cash flows, and lower validations should perform. So for bond investors, there's little to like in traditional corners right now of the market, but the bottom line is we're far from done yet. The post-market action today centered on the Gamestop this week. Shares spiked more than 30% after hours trading after news emerged that the video game retailer's turnaround effort was taking it into cryptocurrencies tokens. So had a little turnaround there, and when now we talk about transitioning to the employee numbers, this is what they said earlier in the week. December employee report, the Department of Labor on average, the economists are expecting to see a gain of 440,000 non-farm payrolls last month after only a gain of 210 dismal in November. Guess what, folks? As of today, added 199,000 jobs. What do these economists know? Off by a huge mark. So investors and economists hoping to judge the impact of the Omicron variant on the jobs market won't have a lot to take away from the December jobs data. That's because the monthly surveys are conducted around the second week of each month. So in the first half of December, the variant was still new in the U.S., but if you listen to the conference calls and the doctors in Africa, what they were seeing, they said it's like a teacup, not an ocean. It's no big deal. People are getting a runny nose and headache. Investors and economists will be more interested in the January and February jobs numbers to judge the Omicron's impact on the economy. Right now, it's minor, ladies and gentlemen, and the top doctors throughout the world know it is. It's not near as close to the Delta. We'll have to keep an eye on it. But right now, interesting way to start off the year. That's the fluff for the week. Have a great weekend. Take care.